Hello, everyone. Today we have Bob Gillespie with us. Over a 30-year career, he has been a venture-backed founder three times, an institutional investor three times, and he has personally advised over 100 early-stage startups. Bob, it's so great to have you on. On one side of the spectrum, you're a high-level institutional capital allocator in your capacity as the managing partner of Reach Commercial at Second Century Ventures. But on the other side of the spectrum, you operate a much smaller and highly specialized private consultancy called CapTable Expert. Take us into your world for a minute. How do you describe what you actually do?
Yeah, well, thanks for having me. First of all, appreciate you having me on. Um, yeah, kind of where it started was, I back in the day I was a founder. I was a three-time founder in three different industries, and I was a C-level CEO, CFO, COO, so operationally, financially, leadership roles, and I have a tech background. Actually, majored in computer science in college, so I was sort of a natural fit for starting companies and really got passionate about it and been kind of running companies since 2001 was my first startup. So after I did that three times, then I kind of was a bit burned out from being the operator and wanted to get into the more on the venture side. So that was sort of where I moved to in about 2015. So I moved over kind of from the operator side over to the venture side late 14. And that's what I've been doing now for about 11 years. So where I'm at now is I'm the managing partner of Reach Commercial, which I'll dig into a little bit. We're a real estate prop tech firm. We invest in companies that are adjacent to real estate. On a technology standpoint, though, we don't invest in like a hotel or an office building. We don't do that. We invest in solutions that help real estate as a asset class move forward. So it could be financial, it could be operating the asset, it could be insurance, it could be earnest money, it could be marketing, anything that touches real estate. It could be fintech, it could be insurtech. So that's my venture job, where I've led the investment into about 70-ish companies. Um, pardon me, over the last 10 years. So that's sort of my profession as venture capitalist. But one thing, as I've been doing this for 25 years now, is that I sort of developed this real detailed expertise in corporate structure and governance and cap tables and investment structures. So when it comes to these are words that I'm sure some of your listeners have heard of, but like your cap table, your capitalization, who owns what in your company? Uh, what's the preferred stock? What's the common stock? Term sheets, equity deals, Series A raises, option pools, 409A valuations, safe notes, convertible notes, warrants, 83B elections, ISO, NSO, 409A, all of the alphabet soup and all of the difficulty and confusion around. I'm a founder and I started a company with my friend and we owned 51% and 49%. And then we took some money from our friends and family. And then we took some professional money. And then we took some institutional money. And how does that all feed into your cap structure and your cap table? I've developed a deep expertise on that. And after sort of picking up a lot of consulting engagements and working with a lot of companies, and then also working with my own companies and my venture firm on all that stuff, I finally launched CapTableExpert.com as sort of two things. One, to kind of as sort of resource for people. There's all kinds of insights and blogs and articles and learnings on there. But I also do consulting outside of prop tech for companies that are doing venture deals, fundraising, safe notes, cleaning up their cap table, preparing for a raise. Perhaps they're going through M&A and activity and they want to get their cap table straight. So I have very, very deep experience in all things capital raising, cap table management, and corporate structure and governance.
Interesting. So let's touch a little bit about Cap Table Expert. And like I said, it seems like a very highly specialized consultancy that you do. And you see these issues, I think, not just with startups or early stage founders, but I think throughout time, whenever there's business, we do come across issues where owners the exit plans aren't clear, what sort of divestment happens. It's always a very messy affair. So if a founder is staring down a messy friends and family round, their default instinct is usually to just hire traditional corporate law firm. How do you position your advisory work at CapTable Expert against that standard
Yeah,
legal?
yeah. And I don't want to. I'm not bad mouthing lawyers. I'm not, because they're very necessary, and some are marvelous and really have deep expertise in startups and entrepreneurship. I think kind of where I position myself is what you can do with me. I'm way cheaper than a lawyer. I just don't charge you $1,100 an hour. I don't do that. So what I tell people is, if you have one, talk to me before you start to get yourself in trouble. I always tell people this: you can spend a couple hours with me up front getting a model built of here's where we are now, here's where we're going to go, and then here's future state modeling of if things happen, what will happen, right? So we've got kind of a current state and future state model. It takes me a couple hours to put that together, and pay me a little bit of money. But now you've got your Bible of what your cap stack looks like. Then when you go raise your safe notes, your early stage safe notes, or your convertible debt notes, or perhaps you do an early equity round, you call me. I work with you a couple more hours. We make sure everything's good. Then you take that to the lawyer and go, now paper this up. I know this is right. You paper this up now, instead of paying them to do all the math and the model that, quite honestly, they don't understand as well as I do. I think the other thing that I find is, when you deal and you let the lawyer try to be your cap table sort of Bible keeper or your system of record, they're not very good at that. They're good at putting things in a folder, in a file, and you've got all your files in one spot. But then 2 years later, you got to go do an autopsy on what does all that mean. So I find that unless you really are on your cap table early and really keep track of it and you're very disciplined about it, I tell people this all the time. You can pay me a couple hours now, or you can pay me a boatload of hours later when it's all screwed up. And that's kind of what I see over and over again. I have customers all the time who call me in an hour, in a quarter. Hey, Bob, can you add this one thing? Yep. Knock it out, send it to them. Great. Then they send it to me 4 months later. Hey, we just gave this guy some equity. Can you update it? Certainly. Half hour later, doom, out the door. What's problematic is when you come to me 2 years later and you go, hey, we did 17 things and I don't really know where the legal documents are. And this signature I got, but we didn't get a counter signature, so I don't really know if we signed it. And then I'm like, okay, well, now you get to spend a ton of money with me and a lawyer to try to go and do an autopsy on what happened, and it's a nightmare.
Okay. Walk me through the actual reality of that first call that you received. We have a founder that that books a call with you, and they just realized that their co-founder departed, but that co-founder still owns 40 or 49% of the business. What does those
I get,
5 minutes, first 5 minutes of that call,
yeah,
of that
that's a
intervention,
good
what
one.
really
You
sound like?
touched on a good one, because that's one that I get a lot. I get a lot. So here's what happens. Uh, Generally, somebody will be talking to somebody. Maybe they don't know me yet, or maybe they found me on search, and they book a call. Usually I take a free call, half hour. Just tell me where you're at. Let's talk about your problem. Let's figure out where we're at. And in this case, this is a very common problem. I'm going to settle in here. This is a good one. I'm going to settle in on my chair because this is a big one. So let's say that you and I, Shiraz, we start a company with the best intention, and you own 51% and I own 49%. Okay. And actually, let's use somebody else. Shiraz, you own 51%, and somebody named Jeff, we don't know Jeff, we can make fun of Jeff. Jeff owns 49%, and you guys start working together, and you guys sign your documents, your stock issuance agreement, and it says that you own 510,000 shares, and he owns 490,000 shares. You got 1 million total shares, and off you go. But now it's, I don't know, 9 months in, and a bunch of things could have happened. Perhaps Jeff just wasn't a very good partner and doesn't put in enough time, and it's your passion. And for him, he's kind of like, yeah, I'd like to do that, but then he gets distracted with some other opportunity. Maybe he's got a consulting firm and he gets busy. Maybe he's married and his wife gets a job in, I believe you said you're in England. Let's say that he's in China and now the time zone doesn't work and he can't work together for whatever reason. Jeff's not going to work out anymore. And you go to Jeff and you go, hey, Jeff, this isn't working out. and that's fine because that happens all the time. And then Jeff goes, yeah, you're right. I'm going to go do this other thing. Go make us some money though. Go get us. I own 49%. Go make us rich. And you're like, what? So then the question is, when they call me, I say, well, when you did this, did you vest each other? Did you guys sign an agreement that says that you have 49%, Shiraz, you have 51, he has 49? But you're not going to own all of that on day one, that you're going to vest into that for 4 years. So you have to be there all that time to earn your equity. So if after a year he leaves, he would own 12 and a quarter, right? 1/4 of 49%. And that you can live with, right? 12 and a quarter percent you can live with. And then they'll say to me, no, we didn't do that. And then I say, okay, well, now your problem is this. You have a couple of options. One, you can try to explain to him that this is never going to work, and that you're never going to be able to raise money, because any investor who knows what they're doing is going to look at your cap table and go, who's Jeff? And you're going to say, oh, he was a guy and we started this and I started with him and then he left. And then they're going to go, oh, and he owns 49% and isn't involved? And you're going to go, yeah. And they're going to go, goodbye. And then that discussion's over. Okay. So now Jeff has to understand, and really the only way to show Jeff that this isn't going to work is to say, hey, Jeff, I have a guy who wants to put some money into the company, but he's never putting money into the company when you own 49%. So we can either let this company die because we can't raise money, and then you, Jeff, get to own 49% of zero, which is pretty easy math. That's zero. Or, Jeff, you can understand that you're going to have to get cut back significantly because you're not here. And when we talk about cut back significantly, we're talking about cutting you back to like 10%. And that's a pretty big number. And then Jeff is going to say, well, hold on, though. I'm giving you 39% of the company, and the new guy's putting in $1 million, and the company's supposedly worth $10 million. I would like my $3.9 million now. And then you have to tell Jeff, you're an insane person. That's never going to happen in a zillion years, because venture capitalists don't put money into companies to buy out old founders. That's not our job as venture capitalists. So Jeff, you're just going to have to relinquish and retire those shares and surrender those back to the company. That's what you're going to do. Otherwise, again, you can own 49% of zero. You can do that. Or you can cut yourself back to 10%, you raise $1 million. Now the company's worth $10 million, and now you own 10% of $10 million. Which would you rather have? And that happens over and over and over. But if you had talked to me when you set your company up, we would have done a couple of things. One, we would look at your owner agreements and make sure that you were vesting. We would have made sure of that. With your vesting, we would have set up an 83B election. This is a United States thing, to keep your tax, to protect your tax downside. We want to make sure that you don't pay taxes in the future for shares at vest when you got them today. So we would take care of your 83B election. We would set up an option pool to be able to incentivize future folks. We would get the right share counts. We would then set up a professional structure for friends and family investment that was reasonable. Then we would take all of that, and this is like a couple of hours because I've done it so many times. And then we would set up a model that shows Shiraz owns 510,000, Jeff owns 490,000. We would have a section for your option holders as you started to give away equity in the future to advisors, to other people who are going to help you. And then we would set up a safe note for friends and family investment. So we had a professional structure for family and friends and early investors that's not going to hurt you later, right? So that's sort of a lot of the work that I do. Then the other work is as you start to take money and this is where things get complicated, and I don't want to get too detailed here, but you'll go raise money and one person uses a convertible note. And then somebody else gives you money and you just want money, man. So you're willing to take it under any structure. And somebody else gives you a safe note that's a little different than the convertible note. And it's a pre-money safe note, which is a flavor. And then somebody else comes in later with a post-money safe note. So now when you convert them, all three of those things convert differently. So you don't have any idea when you take your money that then is going to convert those safes and the convertible debts into equity. You don't know how much they took. You don't know how they convert. You don't know how they interact with each other. My model will tell you all of that, like with a couple of just keystrokes. It'll tell you here's exactly what everybody would have on an as converted future state basis. So that's the kind of work that I do. I've had it happen where people go out and raise a bunch of money, and then when they go to convert it, they realize, oh, I don't own any of my company anymore.
Yeah. Yep.
So then what?
Yeah. You talk about like, the vesting schedule. That's definitely a good thing to have in place. A 6-month cliff, mandatory monthly check-ins. What happens when the founding team actually follows that advice, but then realize by, let's say, month 3 that they fundamentally disagree on performance or any other strategic decisions?
Yep, that's a great question. And I love your structure, by the way, Shiraz. Very well done. I like for founders 6-month cliff. So for the people that don't know that, let's say we have a 4-year vesting schedule, and let's make it easy. We have 3 partners, and we're 40, 40, 20. Okay, and I'm one of the 40 people. I get 40. So that means every year I'm going to get 10%. Okay, but I'm not going to get any of that until the 6th month. And then on that 6th month, I'm going to get 5%. So now I own 5%. And then what I would do is the remaining 40, months left, the remaining 42 months that are left, I would vest them monthly, 1/42 for the rest of it. Okay. I like that because that stops people from being like, well, I'm just going to be lazy for 60 more days because then I'm going to get a whole nother quarter of vesting. Most people would maybe screw around for 2 weeks because it's one more month of vesting. It just sort of stops that kind of laziness factor. But you're right on with 6-month cliff, where I don't get anything until I'm here 6 months. Now, what you're asking me is, what if we don't even get to that 6-month mark? Then what? Well, I think that your monthly check-in is right, where we're going to have a discussion saying, all right, hey, guys, are we on schedule? Us 3, me, Shiraz, and Jeff, 40, 40, 20. We all happy with each other? We all good? Everybody pulling their weight? Everybody, we're on track? And if they're not, we got to be having discussions about that. And hopefully it's not a big surprise in the 3rd month that let's throw Jeff under the bus here, Shiraz. Jeff's not working out. We better have told him at the end of month 1 and the end of month 2 that it's not working out. And then maybe he was working out in month 1 or month 2. Well, at the end of month 3, we still got 3 months to get him on track, right? So we can go, hey, man, we can cut you loose now if you're not happy, but we can also put you on a plan, and we can put together, maybe at the end of month 4, we're back, we're good. We got this 6-month window to play with before that guy walks away with equity, right? Now, if you get to the point where it's just not working out with Jeff and Jeff's got to go and you're before 6 months, this is where you could tell Jeff to pound sand. You can definitely do that and say, hey, man, you didn't make it to the 6-month mark, so you're not going to get anything. What I would probably do is I don't want that guy in my cap table, because that guy now, he's got stock and I'm married to that guy now. Like, that guy's around forever now. So what I would probably do is say, hey, man, we really enjoyed, the 3 months. Thank you very much. We're going to give you, as a token of appreciation, we're going to give you $2,500, $10,000, $5,000. You come up with something that says, hey, man, we appreciate you. Here's a token just to not stiff you for the 3 months. It's not working out. I'm going to throw in $1,000. Shiraz's going to throw in $1,000. We're going to give you $2,000, and thank you so much. So I think it's where reasonable people meet. But sometimes if that guy says, well, that's not enough, you just point to the contract and go, okay, you get nothing. Like, I'm a big guy where I'm a big believer in the document says that, and that's what we're going to adhere to. And anything else I give you is reasonable people trying to do good business.
Yeah. Okay. That's fascinating. So I want to touch a little bit about MedSpas. I noticed that you've been talking about MedSpas, and as part of this podcast, Keep What You Earn podcast. So how does a highly profitable MedSpa manage to make the exact same enterprise value mistakes as a pre-money tech startup? And how?
Yeah, it's interesting because those are very They're different models and they're valued differently and they scale differently, right? So as a med spa, you've got, it's a physical location, right? It generally, it has, you're going to open, the way that you scale that is you have to have multiple offices. That's the way you scale that, right? Maybe you start out, and I'm talking about like an oil change place, a med spa, uh, a plumber, HVAC, services based industries where you're going to open your, a dry cleaner, whatever it is, where I'm going to open up one office, one location, and then we're pretty successful. And then we say, hey, this is going really good. What if we, I'm from Chicago. I've got one on the north side. What if I open one in this other emerging neighborhood on the northwest side? And now you've got two. And then you go and you say, hey, you know what? Actually, we could do one up in the northern suburbs up there. So now we have three. And that's kind of how those med spa, let's call them service businesses, how those scale is by additional locations. Now let's talk about tech. On the other side is tech. You don't have to have a location. You can just be in front of your computer. And the way that scales is through customer acquisition and building software that repeats. I'm selling licenses, man. I've got more servers and more logins. Okay. So they're very different businesses in the way that they scale. They're also very different in the way that they're about capital efficiency. If you think about a tech business, if you kind of do it the real hard way and to make it real big, you have to raise a ton of money and you got to build your tech stack and you got to blow a lot of money up front. But your marginal cost for every new customer is very, very, very tiny, right? Like every time you sell a new copy of Windows, it costs you 0.0001 cents to sell that extra copy of Windows. So your marginal cost is very, very, very low. Once you get to scale, your working capital needs aren't very high, right? Because you're a tech stack. Your profit margin is, your net profit margin is, your gross profit margin is 90%, right? Then you got all your people and your tech and your advertising and all that, that's going to take, but your net margin could approach the mid 30s, right? That's what your Amazons and your Microsofts and your Googles are doing. They're making net margins in the mid 30s, which is an incredible business. Med spas and services business are going to, kind of top out. They're going to have a very high cost of goods sold because every time you do a treatment, you got a person there doing it. You got a doctor, you got a technician, you got a haircut, you got a stylist, you've got the plumber, whatever service, you've got somebody doing that and you got to pay that person. So your margins are not 90%. They are 25%, 30%, your gross margin. And then after you pay all the stuff below the line, your net margin is going to get you to service business, 8 to 10% maybe, right? So they're very different businesses. So scaling a tech business is, nothing's easy, but they scale because of the way that they're built. Services businesses are hard to scale. They really are. Because every time you do it, you got to get a new office, a new haircut person, the new plumber, right, all of that stuff. So they tend to have a much more difficult working capital problem where, by the time they bring money in, get done what they need to do, then by the time they get paid, that hasn't even paid for the second set of money they had to come in. It's like this snowball of working capital that's very, very difficult, right? So they're just very different models. One scales really, really good. And that's why you get the giant multiples on exit is because the scalability. And the other one scales a lot slower. But those businesses tend to be lower margin, but they also have less moving parts, right? Yeah. Like I'm a plumber. I need a couple plumbing vans and I need some plumbers who know what they're doing. And then I got to have people call me up and be like, hey, my toilet's clogged. That's what I need, right? And those no businesses are easy, but those businesses are, they've been around for, over 100 years. So to scale those, you need to add locations and add offices and add more people. Whereas software, you just got to scale it up and you got to get scale through customer acquisition.
So let's go back a little. So you're the managing director at Reach Commercial also. How do you manage the cognitive challenge of zooming out. On one end, you're evaluating the global real estate trends in the morning, and then in the evening, you're zooming all the way in to fix a single pre-seed safe note. Or how how does that work? Is that a challenge for you, or is it something that comes naturally?
Yeah, I think I've been doing it so long. I mean, cap tables are really two things. They're legal docs and structure, and then it's math. That's like in my venture world, I can be wrong a lot. I think a lot of VCs are wrong a lot of the time because you're making a judgment call on whether something's going to work or not. And what is your thesis on AI, for example, or what's your thesis on blockchain or IoT, or the scalability of business A versus scalability of business B, or whatever you need to figure out. It's a lot more sort of, there's definitely a qualitative and quantitative aspect to that where it's part art, part science. I'll look at a company, I'll look at 50 companies, and I'll say, oh man, these 50, these 35, I think are a no for me. That gives me 15 left, and I got to make 8 investments. Okay, well, I kind of think that these 5 are definitely my top 5. Okay, great. So we got 5. Now we got 3 more slots, and I got 10 companies. The market's bigger in this one, but the go to market's harder. Whatever you got to piece together, it's a decision that you have to make, right? And that's what venture is. Cap tables is just, it's right or it's wrong. It's just math. I get all the documents, I get all the legal, I go through everything. And at the end of the day, 1 plus 1 better be equal to 2, right? I'm not making the call on the judgment and my CapTable Expert about you should raise this on this. I can give you opinions about what to raise and what I think your valuation might be and how I might structure it. And this is strategically how I would like to do things. I can do that. But CapTable work is very much like, okay, I got all your documents and this is the answer. It adds up to this. So it really works both sides of my brain. One, I'm very, analytical decision making, art and science. And then I'll tell you this story. I had a client who was working on their cap table, and one of their VCs was a bit of a bear. He was a yeller. Okay. And he was, he would, when you told him something he didn't like, he would yell. And they told me going into the meeting, this guy's very intimidating. So you're bringing your cap table in to show him, the structure, and he's very intimidating. And I just said to him, math doesn't get intimidated. Like, he can yell at me all he wants. Like, the math is the math, and math doesn't get intimidated. So he can stamp his feet as much as he wants. It doesn't matter because 1 plus 1 is 2, and you're not going to tell me it's not. Whereas in the VC world, you could tell me, I think this company sucks. And somebody else could tell me, I think that company's great. And then I got to make a judgment call based on my 25 years of experience of why, and then I got to defend it, and I got to make sure that I can articulate it. And then when I take it to my investment committee, because I have a committee who's got to approve of my, the companies I put forth, I got to do a sales job there. And then also, on cap tables, I can't be wrong because it's math. On VCs, I got to just try to be more right than I am wrong when you're just writing $1 million checks into companies. You just got to be right a lot more often than you're
right. So about Reach Commercial, PropTech funding has obviously contracted globally, and you've pointed out, as part of my research, I noticed that you pointed out that real estate is notoriously protective of its data. How does that protectionism actually force lucrative acquisitions for the startups that you back?
Yeah, it's a terrific question. And it's really been, for 10 years and really, Shaz, for 40, 50 years before that, what was your differentiator if you were a broker, let's say, and you're going to help somebody buy a commercial property in Chicago? Okay, let's just say that's what you're going to do, and that's what you're going to help with. Well, part of your competitive set is that the city, what properties are for sale, You know who's getting divorced, who might have to sell a property because they're divorced. You know whose kid's about to go to college, so you might know that they're going to sell their real estate because they want to move to Texas, whatever it might be. So you got all this great local knowledge. You got all these relationships. But also you've collected probably a bunch of data on comps. So you could look at a building and say, hey, that building right there is similar to 3 other deals that I did. And I know that that property is about $1 million property. So I think we could go in and we could offer, they're saying it's worth 1.2, but I think we could offer 900,000 and we could probably get it for $1 million. And that was sort of localized knowledge. But all the real estate people were like, I know this. You don't know this. I know this. Well, eventually what happened was because of data and because of computers and because of technology, suddenly people started saying, well, I can just go scrape all of the records, public records for what shit was sold for, and I can just create a giant database of every single transaction in Chicago and dump it on a website. And some broker can just pay me $25 to run a report. And he doesn't need to have the 30 years and the institutional knowledge and all these internal systems. So technology just sort of took that competitive advantage and just said, that's not a competitive advantage anymore, right? So real estate knew that that was coming, but some of the big entrenched players were insistent that, well, my data set, I've got, it's that loss, it's the lost cost fallacy, the sunk cost fallacy, right? We spent so much money building these systems to do stuff, and now you're telling me that there's a new thing that's better than us? Yeah, I am telling you that because it's true. So it's taken a while, but real estate has really started to embrace technology in the last 10 years, and now they use all of these systems of record. And then there's companies like acres.com. Go check that thing out. You want to know anything about land? You want to know anything about what's being built, what can be built? You want to go build 4 gas station quickie marts in Capel, Texas, near the airport in Dallas, Fort Worth, because you think that's a growing community. You would use them and say, who else has bought a bunch of land around here where that might go before I spend a couple $1 million acquiring the land? And where's the zoning? What can I build there and what fits there? Like Acres has more data layers than you can possibly imagine. Well, what you used to have to do is you have to call your broker. And then your broker would go, all right, yeah, let me take several months to go find you 15 sites that might work. And then let's go look at those. And then let's underwrite those 15 sites. And let's figure out which 4 we might buy. And that would take 6 months or a year to do that. With Acres, you can literally log into their software and have that done with an analyst in 2 days.
Yeah.
And there's systems all over the place that are doing that. Acres is one that I just talked to Carter the other day. But like what is being done now with data is in AI and all that stuff is just it's just changed the entire industry. And now here's what you can do as a prop tech guy. You can either say, or as a real estate professional, you can either say, I'm old school, man. I'm a 60-year-old guy and I've been doing commercial real estate for 40 years and I don't need this computer magic. I don't need any of this data and all your whiz bang cool solutions. I don't need that. Okay. Yeah. Well, there's a 28-year-old kid now who's going to kick your ass because that 28-year-old kid is using Acres and he's going to call your customer and be like, hey, Jerry's been working on your shit for how long? Like 6 months to get you sites. How about I send you a report in 2 days? How about you want to try me out? And now the 60-year-old guy is like, oh boy. So even those guys are going to get dragged kicking and screaming, or they're going to have to retire because the tools are too good. You can't compete with them.
Yeah.
So my job is to find tools like Acres and invest in them and then get everybody to understand that this is where the market's going. That's what my job is to go pick great companies and then tell the industry, hey, here's my 8 this year. And here's my 8 last year. And this is why I picked them. And this is why they're better. And this is why you should use them. So that's what I do is I have to sort of kind of read the tea leaves of the future and say, this is where the industry is going. And then I got to find the winners that serve that industry.
Fascinating. So you recently launched in the Middle East in Dubai for the 2026 cohort. You're looking at global development on a massive scale. What's like a structural or operational efficiency that you're seeing in those Middle Eastern mega projects that US commercial developers were probably blind to?
Yeah, I think that's a good question, and I'll be honest because I'm U.S. focused, but I know Sadiq is our managing partner there in Dubai. Um, we want to be a global organization. We will be on the forefront of all technology, right? So we're in. We just graduated Canada. I'm in commercial U.S. We have our residential U.S. program. We have a Latin American program, UK, Israel, Middle East, and Australia. So we have 8 geographies. And we just believe that solutions are global and that there's good ideas everywhere. And we don't want to just be US centric solutions, right? And the markets are very different. US market is very developed. So the startups tend to be a little bit further along. But one of the things that we really like about the international play is it's really hard to port a solution from one geography to another because the rules are different, right? Just the way that it works is different. The way that a home is sold in Latin America is different than the way a home is sold in the United States. The process is different. There isn't an MLS. We have an MLS, the multiple listing here, where you just go and talk to your realtor, and they're like, "Here you go. Here's every house that's on sale within this. There you go. Here's everything you need to know." And in Latin America, that's not how that works. There isn't like one general listing site. So obviously, as we were looking at geographies, Latin America, is one of the fastest growing economies just because of the youth of the population and the emerging markets of Brazil and Colombia. We found Israel very, very interesting because of the great technology coming out of Israel and the way that they're supported. Great technology comes out of there. And then the Middle East was a next logical step with the burgeoning Middle East and what's going on in Dubai and the development and a lot of the money there that and I know that I'm reading a book right now about Saudi Arabia. It's been fascinating to read about how one of the things that they're trying to do there is have vision to technology. They don't want to just be an oil producing nation where that's all they do is just we have oil and we pump dinosaur sludge out of the earth and you burn it in your car and that's what we do. So like Saudi Arabia is trying to, and they've been working on reinventing their economy with some things where they're trying, Project 2030, if you know anything about that, they're trying to build these future cities and develop real estate and build these resorts and build the destinations. And there's so much development going on there that we thought a couple of things. One, we thought that there's going to be tools built there in the Middle East that service that region. There's a boatload of development going on in that region. So there's a lot of stuff to be sold into that region. And thirdly, we thought we could take our best in breed international solutions and sell them to those regions as well. So kind of everybody wins. The region wins, the developer wins, our on-site Middle Eastern companies win, and our global companies can all win in this sort of emerging, growing market.
Yeah. So let's try wrapping it up. I am aware of the time, but I want to ask
talk
you
about
this.
stuff all day, man. I'll listen.
I know there's a lot that I
long.
could go on about, but let's cover the basics. But ultimately, whether it's a high margin services company or a commercial real estate platform, it all comes down to the terminal enterprise value. What is the one habit founders need to build today to ensure their company is actually sellable?
Beautiful. All right. Good. Great question. I'm going to flip it for the first part of this answer, and then I'm going to answer your question. Let's talk about failure first. I've been doing this for 25 years. The number one reason that businesses fail is not we ran out of money. It's not our technology didn't work. It's not we got screwed by a vendor. It's not government policy. It's not whatever you think it might be. It's not. Because the thing that I'm going to tell you of why it failed would have fixed all of those problems. The number one reason companies fail is failure to attract enough traction in the marketplace. And that's it. Do you know why you ran out of money? Because you didn't have enough traction and nobody would fund you and you didn't have enough revenue. Do you want to know why your technology didn't work? Because you didn't have enough revenue because you couldn't get the money to make your technology work. Do you know why that the government thing screwed you? Because maybe you were too reliant on government grants and not revenue to keep your company alive. So for me, I think one thing that I've learned in some of the best companies that when they wake up every day, the first thing that they think of is does this work for my customer? How do I get more customers? How do I become more valuable to my customers? How do I become embedded with my customer? How do I become the system of record? How do I become part of the critical path? How do I go from a nice to have to a must have for my customer set? That's the number one thing. Anything that you're doing that doesn't speak to that is probably time better spent trying to figure out how to get more customers and become so must have to them that now you can't fail. Okay. So that would be the number one thing I think as a company that I would focus on. So people talk about unicorns a lot, right? Oh, I want to be a unicorn. Unicorns. You know what I like? I like cockroaches, and and then the cockroach, because you can't kill that thing. That thing ain't gonna go away. It ain't gonna die. That thing's gonna keep going on. No matter what you do to that thing is not gonna die. And then that grows up a little bit, and then it morphs into a greyhound. And then that thing starts running, and I'm like, yeah, I invest in that greyhound. Look at that thing go. Look at that thing go. And then a little more money and a couple more customers, and now that thing's a racehorse. And now that thing's right. And then that thing turns into a dragon, and then that thing sells, and then we make a ton of money, right? So I don't go unicorn hunt. I think that's silliness. I hunt for like a cockroach turning into a greyhound that's going to look like a horse. That's what I like. I just like a thing that thing ain't going to die, and that thing's going to turn into a dragon someday. That's what I want to do, right? Okay. So now that's to get the business successful. Okay. Then to get to exit, to start thinking about exit, and there's guys that do this better than I do. There's a company, a friend of mine, Ladder GTM. So LADDER, like going up a ladder. Ladder GTM. Ladder GTM. Super smart dude. You should have him on. Let me know, and I'll connect you to Mike. Be great. He'd be a great guy to talk about exit. But I've listened to him enough, and I've had enough exits under my belt that I think if you're going to look for exit and liquidity, you can't. A couple things. One, you can't wait for somebody to just knock on your door and be like, hey, I'd like to buy you now. Like, you need to become exit ready. And that's probably 12 to 18 months prior to your exit. Like, you need to figure out what are my KPIs and then start hitting them with regularity. What does my buyer want? Do they want me to be profitable, which probably means less scale? Or do they want me to be scaling like crazy and they don't really care about profit because they want to buy my growth and then they are so big they can turn that into profit? Like, what does my buyers look like? Who buys me? Let's get a hit list together. Let's be reasonable about our valuation metrics, right? So if you're a services business, you're probably talking about, 1 to 2x revenue, something like that. If you're a tech business, depending, 4x, 6x, 8x, whatever it might be. Do some research on analogs, talk to some folks who do this. And then if you're big enough and you got some money, then just go ahead and run a process. Just find a real good, boutique investment bank to then run your process and help you identify, here's the 37 people that would buy you. Let's approach them and let's see who's interested. But I think taking a very pragmatic approach to your exit instead of kind of waiting around and having somebody come court you is kind of a rookie move's not the right move, but less optimal move than kind of taking control of your own exit velocity and being like, okay, I'd like to sell this business in 2 years. So who do we got to talk to figure out what it should look like, what numbers we got to hit, what kind of scale we got, what kind of profitability we have, who's our hit list, what's a reasonable valuation. Knowing all of that, 12 to 18 months out from the transaction, I think puts you way ahead of the curve. And my best companies of mine that have exited, that's what they do.
No, this has been an absolute masterclass in the mechanics of building and protecting a business. And I think you're doing incredible, terrific work for the financial ecosystem. This conversation went exactly where I hoped it would. And thank you so much for doing this. And thank you so much for coming on. It's been a pleasure listening to you and learning about the work that you're doing. It's fascinating. And I'm sure everyone who's listening, they'd share the same thoughts.
Well, thanks, bud. I appreciate it. And, anytime, anything I can do for you. And then my little commercial at the end. If you have a prop tech, I'll give you the easiest email. If you have a prop tech firm and want to talk about that, I'm bob@chicago.com. Easy enough. And if you have CapTable needs, interest in CapTables, you got a startup. CapTableExpert.com is my website. And there's a button on there. You can hit that and you get a free 20-minute thing. And I'm happy to talk to you about your company and all things cap tables and et cetera, et cetera, et cetera. I love hearing about businesses. I'm a good connector. And I love working on cap tables because I'm a nerd who loves math.
We'll make sure to have those links as under the video for sure, but definitely thank you so much.
Thanks, bud.